What is the Capital Asset Pricing Model, CAPM? The Capital Asset Pricing Model, CAPM, calculates the expected return on an asset by weighing the risk against a theoretical risk-free asset. This model is based on modern portfolio theory, which evaluates the relationship between expected return and risk through correlation measures. CAPM focuses on the risk-reward relationship, allowing for greater gains, known as the risk premium, in the case of riskier investments. The risk premium represents a return rate higher than the risk-free rate. CAPM helps investors build well-diversified portfolios by accounting for both systematic risk, associated with the overall market, and specific risk, which is tied to individual assets. The formula used in CAPM considers both the time value of money and the expected risk to estimate returns. The components of the CAPM formula include the expected return, RE, which represents the potential long-term return on an investment, taking into account various market-dependent factors. The risk-free rate, RF, refers to the return rate offered by risk-free securities, such as government bonds, often calculated by subtracting inflation from Treasury bond yields over a typical period of 10 years. Beta symbol measures the volatility of an asset's returns compared to the market. A beta greater than 1 indicates higher volatility than the market, while a beta less than 1 suggests lower volatility. A beta of 1 signifies perfect correlation with the market, while -1 represents a perfect negative correlation. The market risk premium is the additional return expected from a risky investment over the risk-free rate, which compensates for the added risk. Riskier securities, such as growth stocks or smaller companies, offer a higher market risk premium compared to more stable companies. CAPM is built on several assumptions. It assumes fixed asset quantities and perfect competition in security markets, where all investors have access to the same information. Trading expenses, such as taxes and transaction costs, are not considered. There are no market restrictions like borrowing limits or short-selling constraints. Investors are rational, risk-averse, and aim to maximize their returns. The risk-free rate is assumed to remain constant over time, and returns are believed to follow a normal distribution. Despite these assumptions being more suited to ideal conditions rather than real-world scenarios, CAPM has several practical applications. It provides a straightforward method to calculate the cost of equity, helping investors assess returns more easily. CAPM concepts illustrate the relationship between market risk, return, and volatility, offering a broad view of potential future returns. The model is useful for comparing the expected performance of various securities, as well as evaluating returns relative to the market. It also supports the creation of a diversified portfolio by balancing risky assets to minimize overall volatility.